when real interest rates are falling, confidence in the currency and confidence in the government's solvency is in question. It's exactly what's going to happen. So do we have a short-term problem for gold here? Yes, it could last several months, several quarters even. I'm not sure, but I will pick up on it when things change. Right now, gold is not my favorite play, and silver is not either. But they will be mandatory investments down the road once again.
Interest in gold investing has been rising throughout the year, mainly driven by a consistent price increase. Over the past 11 months, gold has repeatedly set new records, attracting a growing number of investors to the precious metal. In early November, gold prices suddenly dropped, falling from a near-record high of $2,736 per ounce on November 1st to the current level of $2,560 per ounce. This decline has left many investors questioning whether they should reassess their strategies for investing in precious metals. Analysts point to robust U.S. economic data and a resilient dollar as crucial factors behind the recent dip in gold prices, making the metal less appealing as a safe haven asset. Looking forward, market experts indicate that gold's future direction will hinge on upcoming economic indicators and statements from the Federal Reserve. These factors will likely play a significant role in shaping investor sentiment and influencing gold's trajectory in the coming months. Michael Pento observes that Donald Trump's election shifted the outlook for gold. Following Trump's win, particularly after Jerome Powell's interest rate cuts in September, long-term interest rates on the yield curve have jumped significantly, creating more competition for gold as an investment. Despite recent challenges, Pento is confident in gold's long-term potential. He anticipates that over time the dollar will weaken, forcing the Federal Reserve to monetize trillions of dollars in Treasury debt, similar to past actions. This situation would likely lead to lower nominal rates and falling accurate interest rates, creating a favorable environment for gold as a top investment choice. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
Gold likes it when nominal and real interest rates are falling and there's less competition for stocks. So think about a recession. Gold, the best sector, I have a 5-sector portfolio. The best sectors are sectors 1 and 2. So that's disinflation and deflation. So if you think about fears of recession, fears of chaos in DC, gold was thriving up until the election. And think about it. Well, if I think a recession is coming, and I think chaos is going to occur in our political environment, then earnings would be going down. So stocks would not be a good alternative. And nominal rates are falling. And that's less competition for gold, which is money, which competes with money markets. And I'd rather own gold than lose money in stocks. That was the calculation heading into the election. Now with the election of Donald Trump, what's happened to interest rates? Actually, not only since Trump has been elected, but what happened to interest rates since Powell cut interest rates in September? Mm-hmm. Interest rates on the long end of the yield curve are flying higher. They're flying higher. So that's more competition, even short-term rate. If you even look at a 2-year note, the rates are rising across the yield curve. Now, I know the Fed funds rate is going down slowly now, very slowly now. I don't think Powell's going to be able to cut this rate to 2.5%, 3% very quickly, like what I thought was going to happen if Kamala Harris was elected. She wasn't. You have to react to these changes. So gold is now the calculation for gold is I've elected a president who's more pro-growth, more pro-inflation. Interest rates are rising. There's more competition for gold, which is an asset that doesn't bear any interest. And by the way, earnings could be better too. So let's buy some stocks. And you throw onto that poop pile the fact that the president, for some strange reason, loves shitcoin. He loves cryptocurrencies. Instead of tying the nation's currency to gold, as Article 1, Section 10 of the Constitution says, he loves Bitcoin. Okay, so he loves Bitcoin. Bitcoin is flying, which is, some people think it's competition for gold. So people are going to Bitcoin. And what has the dollar done since the election? Because we have more growth supposedly in the pipeline. The dollar has risen. So you have a higher dollar, higher interest rates, more competition for Bitcoin, higher growth, higher inflation. All those things are deadly for gold. And that is why I sold my position down to, about 4 or 5% in the portfolio, and it could go down even lower. However, Danny, here's some good news. Longer term, like we talked about on this program, longer term, what's going to happen is the dollar is going to crash, and we're going to have a central bank that's forced to monetize trillions of dollars in treasury debt, like they've done before. They did it before, they'll do it again. And that means nominal rates will be lower than normally would be, and real interest rates will be falling. And that is when you want to buy gold, most of all, is when real interest rates are falling, confidence in the currency and confidence in the government's solvency is in question. It's exactly what's going to happen. So do we have a short-term, problem for gold here? Yes, it could last several months, several quarters even. I'm not sure, but I will pick up on it when things change. Right now, gold is not my favorite play, and silver is not either. But they will be mandatory investments down the road once again.
In October, annual inflation in the U.S. likely increased for the first time in 7 months, indicating that price rises may stabilize after a prolonged cooling period of over 2 years. A survey of economists conducted by FactSet suggests that consumer prices rose by 2.6% year over year, up from 2.4% in September. This recent uptick in inflation has sparked speculation about potential adjustments to the Federal Reserve's monetary policy. In response to the inflation data, market sentiment has shifted. The CME FedWatch tool now shows a 62% likelihood of a 25 basis point rate cut in December, down from 83% just a day earlier, reflecting uncertainty about how the Fed will navigate this changing economic landscape. Michael Pento predicts that inflation may accelerate, rising from the current 2.5 to 3% range to as high as 4 to 5% in the coming quarters. He also highlights that several policies linked to Donald Trump, while favorable compared to other options in his opinion, tend to drive inflation. Among these are tariffs, which Pento characterizes as a one-time cost increase. These tariffs, he explains, impose an initial shock to prices, contributing to inflationary pressures. Let's now turn our attention to the video again.
There's going to be massive fiscal and maybe even some monetary stimuli down the road. And this is going to just, I think, delay and defray the recession for a little while longer. But as a caveat, it in no way eliminates the massive bubble that we have in stocks, bonds, and in real estate. So that hasn't gone away. It's getting worse and worse. But I do believe there's going to be enough, tax cuts and, you're giving people no taxes on Social Security, no taxes on tips. Corporate taxes are going to 15%. So I think there'll be more growth and a little more inflation, and perhaps a lot of inflation. And what I'm most myopically focused on is the long end of the bond market. The long end of the bond market is not going to be happy when these things get passed. And if rates rise slowly and nominally in the context of a growing economy, then we could kick the recession down the road for maybe another year or two. That's a possibility. If we get a little bit of growth and a lot more inflation and rates rise because there's problems in the credit markets, repo markets freeze up, and you can get a shock like we had over there in Britain, and that's a 1987 type of moment. So listen, I haven't been short the market since early 2023. I'm net long the market, enjoying, a good part of this ride up. But I do have a cautionary tale to tell you. We are going to have a grand reconciliation of asset prices. Trump's election does nothing in the way of preventing that from happening. It's going to happen. And I believe the catalyst will be from the absolute skyrocketing of long duration bonds in our treasury complex. And the worst part of it is that inflation is there. So when people who will asininely say, well, inflation's way down. And what they're really saying to you is, well, prices are way down. No, prices are rising more slowly. It's called in the second derivative disinflation. So prices are rising more slowly from a level that most of the middle class, most of the country, the bottom 4 quintiles could not afford. The fact that they're rising at all is salt on the wound to them. So the fact that they're not rising at 9 anymore, I guess it's better that they're rising at 2.5 to 3, but they're rising from an unaffordable level, and they're going to be going up even more quickly. Say from 2.5 to 3 to maybe 4 or 5% in the next few quarters. So a lot of these policies that Donald Trump, far better in my opinion than Kamala Harris, but they are inflationary. Tariffs are a one-time hit to the cost of money. So that's going to be, if you put 60% tariffs on everything that comes from China. Have you ever gone Christmas shopping and flip the boxes over and see where things are made? Everything's made in China. Mm-hmm. Okay. So it'd be a one-time shock that comes on top of a massive COVID shock. And then you're going to have, the king of all debt and the king of a weak dollar. I don't know if that's really deflationary, right?
Gold prices experienced their largest weekly decline since September 2023, falling to a 2-month low last week, largely due to a strong US dollar rally, which reached a 1-year high. Despite this, geopolitical developments over the weekend triggered some safe haven demand, helping gold regain positive momentum. However, prices remained below the $2,600 mark as market expectations shifted toward a less aggressive rate cut cycle by the Federal Reserve. This outlook on monetary policy has kept upward pressure on gold prices in check. Do you view the recent pullback in gold prices as a buying opportunity, or are you cautious about investing in precious metals given the broader economic conditions? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.